Very good morning, friends. So I hope you're all doing well. And most importantly, I guess you've already looked at the lectures of financial instruments. We had spent almost around 15 lectures on financial instruments. It's a very important topic from the examination point of view. And of course, from a practical aspect point of view as well. I think if you don't get a hold on financial instruments, I would say practically you do not get a hold on the Indian accounting standards. So we're going to spend two lectures on financial instruments. One is today and one is on Tuesday. And of course, the presumption is that you've already looked at the lectures because I'll run through certain concepts with you because it is impossible to give you the details of every concept on financial instruments in two lectures. So the idea is that you've already watched for them. And of course, we'll take up your questions also towards the end, any kind of questions which are there on financial instruments. Now, I guess as I start with financial instruments, let me tell you, and let me remind you rather, that there are a total of three standards which are there on financial instruments. So just to take a quick recap on the concept of financial instruments. So when we look at financial instruments, this is one of the only standards where a total of three standards have been devoted. So imagine the intensity of the topic where you've got a total of three standards devoted to just one particular topic. That makes it, the complexities of the topic, of course, is quite good. So financial instrument is addressed in terms of three standards. One is, as we know, Ind AS 32. The second one is Ind AS 109. And the third one is Ind AS 107. So these are the three standards which are devoted to the concept of financial instruments. Now, what does each standard deal with? The name of every standard, of course, is financial instruments. But when you look at Ind AS 32, it talks of financial instruments presentation. When you look at Ind AS 109, it talks of financial instruments recognition and measurement. So it talks of recognition as well as measurement. And then when we come to Ind AS 107, it talks of financial instruments, that is disclosures. So let's, I think, quickly look at, what each standard deals with. Now, if you're looking in terms of Ind AS 32, as the name is suggestive that it is presentation, presentation is always in financial statements. And when we say financial statements, it means a balance sheet, it means a profit and loss. But the focus in terms of Ind AS 32 is typically, you can say, balance sheet. So when we're looking at a presentation, you can say, in the balance sheet of a company. So I think let's remind ourselves, when we prepare the balance sheet of a company, we've got on the liability side, equity and liability. The asset side is just the asset side. But when it comes to presenting things on the liability side of the balance sheet, there are two sections in the balance sheet of the company. It says equity and liability. Equity, as we know, is own funds. And liability, as we know, is a loan funds. So the focus is mainly when a particular company, which is called an issuer, issues a particular instrument, we need to decide a classification, or we can say we need to decide a presentation. Is the instrument issued going to be presented as equity, or is it going to be presented as a liability on the balance sheet? Well, the focus in terms of Ind AS 32 is not on accounting, though there is a guidance which is given on the accounting for compound financial instruments, but the focus is mainly on the presentation part. How do you present an instrument? Is it equity? Is it liability? Or I would say it's a blend of equity and liability. I've just added something. So when a company issues an instrument, it has to take one of the three calls. Is it a pure equity? Is it a pure liability? Or is it a blend of equity liability? So do we present the instrument as equity or a blend of equity liability or just a liability? So that is the focus. The second area is when it comes to Ind AS 109, the word is recognition and measurement. Recognition means that if you fulfill the parameters, do we recognize it in the balance sheet of the company or not? And once you say yes, it is recognized in the balance sheet of the company, what is the amount at which it is valued at? So that is called the measurement aspect. So our main focus in terms of 109 is going to be on the measurement aspect, that what is the amount at which it is going to be recorded in the books of accounts. And we're going to focus in terms of the measurement, whether it is initial measurement or whether it is a subsequent measurement. You need to be very clear in terms of financial assets and in terms of financial liability. What is the value at which it is initially recorded in the books of accounts? What is the value at which it is recorded subsequently year by year in the books of accounts? So the focus is more on the accounting. The focus is more on the measurement aspects. And then comes the area as far as disclosures are concerned. So these are the disclosures which are going to be made in the notes to accounts. So we can say in a nutshell, the three standards are focusing on three different aspects of financial instruments. Ind AS 32 is talking in terms of presentation in the balance sheet of the company. Ind AS 107 is focusing on the disclosures in the notes to accounts, and the main core accounting is given in terms of Ind AS 109, which tells you how the financial assets and financial liabilities are accounted in the books of accounts initially and on a subsequent level. So that is the basic crux, the three standards devoted to the concept of financial instruments. Now, what I'm going to do, of course, we're going to start a journey in terms of Ind AS 32 today. And of course, as I said, the presumption is that you've already watched the lectures, and I'm not going to teach you everything from the scratch, but I'm going to make some mind maps. I'm going to make some quick charts, which will, consolidate the learnings in terms of different aspects of 32. In between, of course, I'll do some questions also with you. Once Ind AS 32 gets over, then we come to the focus in terms of 109. 107 is a purely disclosure standard, so I'm not picking up this in terms of just 2 sessions. So our focus would be in terms of 32 as well as in terms of 109. So let's begin the journey, and let's start in terms of Ind AS 32. That is presentation. Now, let's remind you certain key inputs at this particular stage when you're looking in terms of accounting. So let's have a look at 32. What is the main focus? I always tell people that there is one important aspect which you need to keep in mind, and that is when a company issues an instrument, you are not supposed to look at the name of the instrument. The name of the instrument can never be a deciding factor. You cannot say that if a company issues equity shares, I cannot say that it is supposed to be equity. If a company issues a debenture, I cannot say that it is supposed to be a liability. So one of the most important aspects what we need to keep in mind is we are looking at the substance over the legal form. So we're not concerned with the nomenclature of the instrument. We cannot decide its equity or liability based on the name of the instrument. So the main key focus, when a company issues an instrument, we say he is supposed to be an issuer, and the other party which makes an investment in this particular instrument is called a holder. So when a company would issue an instrument, we will say he is an issuer. And when the company makes an investment in that instrument, we say he is a holder. So the perception in terms of Ind AS 32 is to decide from the issuer point of view that is it supposed to be equity? Is it supposed to be a financial liability, or is it supposed to be, you can say, a mix of, you can say, equity plus financial liability, what we technically call a compound financial instrument. So the focus in terms of Ind AS 32 is very clear. We start looking at when an issuer issues an instrument, he basically enters into a contract with the other party. And under this particular contract, is the instrument to be classified as a equity, or is it a financial liability, or is it a mix of debt equity? That is called a compound financial instrument. And for this particular purpose, as I said earlier, we cannot consider the name of the instrument. The name of the financial instrument is not a deciding criteria. That's what we need to keep in mind. So we need to look at the larger picture. We need to look at the concept, and we need to see the substance of the transaction, whether the instrument is FL, equity, or a blend. Name of the instrument is going to be absolutely irrelevant in nature. And what I have done, in order to decide the instrument is in which nature, we've got a simple three-step model. So I'm just going to give you a three-step model. We've done this in detail, but I'm just going to make a walkthrough in terms of a three-step model. How would you decide whether a particular instrument is equity, FL, or not? So my chain of thought is going to be something like this. I'm going to first of all give you a three-step model. Then I'm going to make a total of almost like 3 to 4 charts, which will summarize different aspects that which instruments are of what nature. Because we're going to consider a blend of mode of payments, and on that basis, we'll decide things. So let's focus on the three-step model in terms of deciding things. So we're going to consider a simple three-step model in order to decide whether instrument is equity, FL, or we can say it is a CFI. Now, the first thing what you need to keep in mind is the step number 1. The first focus is in terms of step number 1, that is there a contractual obligation? So the first focus what you need to look at is that is there a contractual obligation? So we need to see whether the issuer has got a contractual obligation or not. So his obligation has to be contractual in nature. Now, when I say the obligation is contractual in nature, now there is one particular point at which we tend to get confused. When I say obligation, the obligation can be either contractual or it can be legal in nature. Now, let me tell you, legal is supposed to be a wider term. So I think one thing which I like to caution at this particular stage, when I use the word legal obligation is going to comprise of by law as well as by contract. So I would say legal obligation is a wider term. When I use the word legal obligation, it's a wider term because legal obligation includes obligation by way of law. Legal obligation also includes an obligation by way of contract. But in this particular case, we are looking at only one aspect of the obligation, that is contractual. So if there is any obligation which arises because of law, it's not considered contractual in nature, mind you. Like, for example, when I say that I have an obligation to pay taxes to the government, it is supposed to be a legal obligation in the sense I am required by law that I am supposed to pay income tax, but that's not a contractual obligation. So what is most important for financial instrument is that you need to first of all zero down on the fact that there is an obligation which is contractual in nature. It should be by virtue of entering a contract. It is not by virtue of law. That's one thing. So remember, legal is a wider term. Contractual is just one of the elements of a legal obligation. Second important aspect. When you look at the concept of a legal obligation, contractual obligation, I'm now focusing on the word obligation. And I would say there are always two elements of obligation in a contract. When you're looking at an obligation in a contract, there are two elements of obligation. One is the principal element. And one is supposed to be the return element. the return in the form of interest, the return in the form of dividends. So when a company is looking into obligation, remember there are two elements of obligation. One is the principal portion. As an entity, if I borrowed money, I've got two inputs. Number one, I have an obligation to pay the principal money. I have an obligation to pay the interest or the dividend element as well. Now, be cautious. When you're deciding the nature of the instrument, please make a run through for the principal element separately and for the return element separately. There is a possibility that the principal element turns out to be a financial liability, or the return element turns out to be equity instrument. So each and every element of the obligation, the principal and return, is to be separately evaluated. That's a very important input. So you need to separately evaluate whether the principal portion is FL equity. You need to evaluate whether return element is supposed to be FL equity, and then take an overall picture whether the instrument is FL equity or a compound financial instrument. So your step number one is going to focus on two things. The moment you look at a particular question, there are two focus points which should immediately come to your mind. The focus point number one is the obligation is contractual in nature, not legal. Legal is a wider concept as compared to contractual, because legal includes by law as well as by contract. But when you're looking in terms of financial instrument standard, the focus is contractual, just contractual, not law. The second focus point is that obligation has got two elements. So you need to make a run through and decide, is the principal FL equity? Is the return FL equity? That's one. So the moment you say that, yes, there is a contractual obligation. So when you put across this question and you say, yes, there is a contractual obligation, or you say, no, there is no contractual obligation. So if you say that there is no contractual obligation in this particular case, we can say the standard is not applicable. Because the moment you reach a conclusion that in this particular case there is no contractual obligation, the standard would not apply. And the moment you say, yes, there is a contractual obligation, you got to go to the step number two. So the moment you apply step-by-step approach, trust me, it becomes very easy to crack down the question. Now, the second focus point, once you've identified the step number one, we go to the step number two in this particular case. Now, the key focus point in terms of step number two is looking at the mode of payment. Now, that's a very crucial point. The concept of identifying whether an instrument is a financial liability or equity instrument or maybe a CFI, you need to consider what is the mode of payment. So your second focus point is going to be on the mode of payment. My second focus point is going to be on the mode of payment. And I think at this stage, let me also remind you, I would not say that what I'm saying is 100% correct, but at least considering the examination point of view, it would not be wrong to say that there is an exhaustive list of mode of payment. When you're looking at financial instruments, I would say basically there are two modes of payment. One is cash, and one is you use your own equity shares as a currency note. So one is that I discharge my contractual obligation by way of cash. The other is I use my own equity shares as a currency note to discharge the obligation. Remember, if your obligation will be discharged by any mode other than these two, the standard would not apply. For example, I might have taken an advance from a customer. So the advance which I received from the customer, I have an obligation, but the obligation is not to pay cash. The obligation is not to pay equity shares, but the obligation is that I will give goods and services in return of the advance taken. So if your mode of payment is by way of goods and services to be given to the other party, it is not a financial instrument. So what is most important aspect is the mode of payment. Your contractual obligation is discharged by which mode of payment? So let's put it like this. So we can say when you're looking at the mode of payment, I would say this is two exhaustive modes of payment. Either we pay in cash or we consider our own equity shares as a currency note. The company uses its own equity shares as a currency note for the purpose of discharge of obligations. So let's put it out here that if your mode of payment is, for example, goods and services, if your mode of payment is supposed to be, let's say, goods and services, it is not a case of financial instrument. So any kind of prepaid expenses, any kind of advance received from the customer, in all those cases, what will happen? Your contractual obligations is going to be paid by way of goods and services, then it's not a financial instrument. Now, another very important aspect. When you're looking at a mode of payment being cash, people generally tend to say, okay, if it is a mode of payment cash, it is a financial liability. No, don't jump to the conclusion that if the mode of payment is cash, it becomes a financial liability. No, no, no. So what we're going to do, let's have a little more insights that if the mode of payment is cash, how are you going to look at whether it is FL, equity, etc. Now let's watch this. So when you're looking in terms of mode of payment as cash, I would say that there are certain terms we need to be careful of. If you remember in step one, I said your obligation has got two elements, the principal as well as the return. Now, we might use certain, terms with reference to principal. Like, for example, we say it is redeemable. Like, for example, we say it is irredeemable. Similarly, in terms of the return element, that is interest and dividends, we may use terms like mandatory. We may use the terms like discretionary. So when you read a particular question, your focus needs to be very clear that when you're looking at the principal component of the instrument, is the principal redeemable, irredeemable? When you're looking at the return component of the instrument, is it mandatory? Is it discretionary in nature? So when your mode of payment is cash, your focus points needs to be in the form of this chart. Your focus points needs to be in the form of this chart. Are you looking at the principal component of the instrument? Are you looking at the return component of the instrument, which is in the form of interest as well as dividends? Locate the keywords which are given in the question. Is the examiner telling you, as far as the principal component is concerned, is it redeemable? Or is it irredeemable in nature? Now, when you say that the principal component is supposed to be redeemable in nature, this means there is an unavoidable obligation to pay. The moment you say that your principal element is redeemable in nature, it per se means there is an unavoidable obligation to pay. It becomes a financial liability. But the moment you say that it is irredeemable in nature, then it is avoidable obligation to pay, and that component is going to become equity instrument. So when you look at the principal component of the instrument, look at the words redeemable, irredeemable. So the moment I say redeemable, there is an unavoidable obligation to pay cash. It's an FL. The moment I say it is irredeemable, there is an unavoidable obligation to pay, and it becomes equity. Similarly, in terms of return, you're going to look at whether it is mandatory in nature, or the term used could be it is discretionary in nature. The interest and dividends which are going to be paid is either mandatory or it is discretionary in nature. So let's keep one principle at the back of the mind. You're going to call a component as a financial liability when there is an unavoidable obligations to pay cash. The moment there is an obligation to pay cash, it's not financial liability. What is the key importance is unavoidable obligation. Mujhe dena hi padega. So when you say that there is an unavoidable obligations to pay cash, it becomes a financial liability. So when I say it's mandatory in nature, it indicates the component is financial liability. And when you say it is discretionary in nature, then that component becomes equity. So I think it's pertinent to remind you another thing at this stage. As I said, you are going to run this three-step model twice. That's a very important statement which I am making. You need to run this three-step model twice. You need to run this for the principal component separately. You need to run this for the return component separately. Take your decisions on the principal component separately. Is the principal component FL or equity? Run this three-step model for the return element separately. Decide, is it supposed to be FL or equity? And then you need to consider if both the components are FL. Mind you, if both the components are FL, it is an FL. If both the components are equity, it is an equity. But if one component is FL, other component is equity, it becomes a CFI. Let's put this once again. That's a very important aspect. So when you're looking at a particular question, you need to run your three-step model twice in place. For the principal component, run it and decide equity FL. For the return element, run it and decide, is it equity or FL? And then you need to consider both the inputs together, both components FL, the instrument is FL in nature. Both components equity, the instrument is equity in nature. One of the components is FL, the other component is equity, it becomes a compound financial instrument. I hope the position is very clear. So this is the second step which I gave you, that if the mode of payment is cash, don't reach a conclusion that it is FL. Look at these words and then take a call that if it is mandatory, if it is redeemable, it is FL. If it is discretionary, if it is irredeemable, it is equity in nature. And now let's come back. If the mode of payment is equity shares, don't jump to conclusion, go to step 3. So let's, I think, consolidate the picture out here before we take it further. And let me see if any questions coming so far. All good to go. So my focus points, number 1. When you start the journey of this three-step model, get the facts very clear. You need to run this three-step model separately for the principal as well as for the return element. That's one focus point. In step number 1, you're going to put a question, is the obligation contractual in nature? If you say no, I'm out of the standard. If you say yes, I go to the step number 2. And in terms of the step number 2, your focus is on the mode of payment. If the mode of payment is cash, don't outrightly say it's FL. Look at the terminology, redeemable, irredeemable, discretionary, mandatory. That's the key focus point. And if the mode of payment is equity shares, you go on to the step number 3. So let's have a look now on step number 3, if the mode of payment is equity shares. So if the mode of payment is equity shares, now let's have a look at what will be the conclusions. We've already discussed the detailed logic of, why a payment in cash becomes an FL or why a payment in equity shares would become a FL or equity. Well, I think I'll not run the logics at this particular stage because that we've already covered in detail in the previous lectures. So I'm just going to give you the inputs that if the mode of payment is equity shares, what do we do? You now need to watch out in step 3 regarding the number of equity shares. So is the number of equity shares which will be issued at a later date, the number of equity shares which will be issued at a later date, is it predetermined? Is it fixed in number? Or is it something which is going to vary? So we need to see, is the number of shares fixed or variable in nature? So when you say that the number of shares is fixed, fixed means it is already predetermined. Fixed means it is already predetermined. We've already pre-decided the number of shares. Or we can say the number of shares is supposed to be variable in nature. Now, the standard makes it very clear that if you are going to issue a fixed number of equity shares, in that case, it is considered equity instrument. And we've seen the logic earlier that the moment you're going to give fixed number of equity shares, you are indirectly passing on the risk to the holder. And the moment you pass on the risk to the holder, it becomes a case of an equity instrument. So if it is a predetermined fixed number, it's going to be considered as equity. And if it is variable, then it is financial liability. So I think let's take a quick look at the three-step model in a consolidated manner. Then I'm ready to make some interesting charts with you. So when you look at a particular question, what do you need to do first of all? When you read the question, first take a call that you're going to apply this three-step model to the principal separately. You're going to apply this three-step model to the return element separately. Run this three-step model for the principal on a separate basis and for the return on a separate basis. That's one point. Irrespective, the mode of payment is common, or irrespective, the mode of payment is different for the different components. Now, once you've taken a call that I'm going to run this three-step model separately for the two components, now there are basically two steps which you need to focus on. If your mode of payment is cash, look at the words redeemable, irredeemable, mandatory, discretionary. And that would decide whether it is FL or equity in nature. So the moment you get mode of payment cash, what should flash at the back of the mind is mandatory, discretionary, redeemable, irredeemable in nature. And the moment you come to the focus that it is number of shares, equity shares, your focus is fixed and variable. So the key issue is when I say cash, your mind should flash on redeemable, irredeemable, mandatory, discretionary. When I say equity shares, your mind should immediately flash on fixed and variable in nature. Now, what we're going to do at this stage, as I promised, I am now going to make some charts with you. The chart number 1, where I am going to consider the mode of payment as cash only. Whether it is for the principal, whether it is for the return element, let's consider the chart number 1 where the mode of payment is only cash. Then we make another chart number 2 where the mode of payment is only equity shares. And then let's consider a chart number 3 where we're going to consider a blend where let's say one of the mode of payment is cash and for the other component, let's say the mode of payment is equity shares. So I think these 3 charts will give you a basic input of different permutation combinations which could apply. Watch these charts carefully because this is going to give you a good insight in terms of things. So let's begin the journey and let's start with the chart number 1. So I'm focusing first of all on the chart number 1, where I'm considering the mode of payment as cash only. Whether it is principal or whether it is return, I'm considering both the components are going to be paid in cash. Now, generally, as I said earlier, many students say, oh, mode of payment is cash. Sir, it is financial liability. Please don't reach the conclusion so fast that if the mode of payment is cash, it's not FL. You need to see mandatory, discretionary, redeemable, irredeemable. So let's do one thing. Let's create some permutation combinations. And you're going to see some exhaustive permutation combinations coming in. So I'm taking 2 components of the obligation. One is with reference to the principal, and the other one is with reference to return. And I need to decide on the nature of the instrument. Is it FL, is it equity, or a blend of the two? Now look at the permutation combinations very carefully. Number 1. Let's say I'm looking at it is redeemable and this is mandatory. Now you got to run the model for both the components separately. So when I say redeemable, what comes to the mind is FL. When I say it is mandatory, what comes to the mind is FL. And I give you the combination that if both the components are financial liability, the instrument overall is a financial liability. If both the components are supposed to be equity in nature, then you can say the overall instrument is equity instrument in nature. If one of the elements is financial liability and the other element is equity, we can say it is a compound financial instrument. So we're going to look at each and every component of the instrument. So when I say redeemable FL, mandatory FL, FL plus FL, we can say the overall instrument in this case is supposed to be a financial liability. I hope you got the picture, the trick in terms of deciding things. Let's look at the combination number two. Let's keep this redeemable and let's keep this as discretionary in nature. Now, when I say in this particular case, it is redeemable, it is FL was equity. So you can say it is FL plus equity. So one of the components equity, it becomes a compound financial instrument. Try the questions which are given in the study material, and you'll see when you read the question is giving you insights on the principal element on a separate basis, the return element on a separate basis. Take a call on the principal, take a call on the return, and then decide on an overall basis the nature of the instrument. Let's look at some more permutation combinations with you. So let's consider this is irredeemable. And let's consider this is mandatory. And you can see that all permutation combinations are coming into play. Now, when I say it is irredeemable in nature, immediately it comes equity. And when I say it is mandatory, it is FL. So this is equity and this is FL. One of the components equity, other one is FL. It becomes a compound financial instrument. And let's look at another combination now. So let's say this is irredeemable and let's say this is discretionary. If you would have noticed, and I'm sure you would have noticed, that what I did, I took redeemable as a base, one mandatory and discretionary. Then I took irredeemable, one mandatory and discretionary. Trust me, there cannot be a fifth permutation combination. If your mode of payment is going to be cash, in this particular case, you can have only four combinations: mandatory, discretionary, redeemable, irredeemable. That's it. So when I say it is irredeemable, it means it is supposed to be equity. When I say discretionary, it is again equity. So both the components are equity in this case, and on an overall basis, it becomes equity instrument. Wow. So I guess my chart number one would be pretty clear that I was focusing on the mode of payment is purely cash. So when the mode of payment is purely cash, one thing which we tend to forget is that if the mode of payment is cash, people generally say it is FL. No, 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 please don't do that. The moment I say the mode of payment is cash, your mind should start running on the principal and the return on a separate basis. Look at the terminologies, the attachment of the terms: mandatory and discretionary for a return, redeemable, irredeemable for a principal, and then comes the conclusion on the basis of the instrument. Okay, so this is chart number one. Let's have a look now at a chart number two. So let's have a look at the chart number two, where I'm now going to consider the mode of payment as equity shares only. And then the chart number three, which is going to be a blend on cash and equity shares combined offer. So in the chart number two, let's consider the mode of payment is supposed to be equity shares only. So whether it is a principal element or whether it is supposed to be the return element, I am considering the mode of payment as equity shares only. Well, I see in this particular case two permutations and combinations. Because if you're going to give both the return and the principal in terms of equity shares, I see two permutations and combinations. Let's see which one. Now watch this very carefully. The two permutation combinations which I am creating in this particular case. One is I consider the principal compounded at a given rate of interest for n number of years. Look at the focus on the numerator. I've taken the principal and I'm compounding this principal at a given rate of interest for n number of years. That means I am not giving any payment of interest interim in between. I tell the holder that I will give you a lump sum money at the end of, let's say, 5 years, at the end of 10 years, no outflows in between. So you're going to give him the principal with the interest compounded at a given rate of interest. and I divide this by the fair value on the date of issue. I divide this by the fair value on the date of issue. Now just imagine if you're going to divide this numerator by the fair value on the date of issue, you are pre-deciding the number. Your number of shares is going to be fixed in this particular case, because when you divide this by the fair value on the date of issue, you are deciding the number in advance. So you are deciding a fixed number of equity shares to be given at the very inception. And if you predetermine the number of shares, in this particular case, it becomes an equity instrument. So the focus is the number pre-decided? Is the number supposed to be fixed in nature? So the moment you consider the fair value at the time of issue, you pre-decided the number of shares to be given, and it is going to become a case of equity instrument. Alternatively, let's look at the second permutation combination. Let's consider the same numerator, principal compounded at a given rate of interest for n number of years. So you're telling the stakeholder that I will pay the principal compounded at a given rate of interest for n number of years, and I divide this by the fair value on the date of conversion. I decide and I say I'll divide this by the price, the fair value which will prevail after a period of 5 years. So you tell the person, I'll give you as many shares as the price of the share is on the rate of conversion. So if you are considering the fair value of the equity share on the rate of conversion, you are not pre-deciding the number, but it is supposed to be a variable number of shares. Because the number of shares you will land up giving after 5 years or 10 years will be based on the price which will prevail after a period of 5 or 10 years. So we can say it is variable in number. And the moment it is variable in number, it becomes a financial liability. So I think there are two combinations which can happen in terms of the chart number 2 when the mode of payment is supposed to be equity shares. You need to be careful that when you are calculating the number of shares, is it based on the fair value at the time of issue? If yes, it is a predetermined fixed number of shares, equity. If you're going to divide it by the fair value on the date of conversion, it's not a predetermined number, it's a variable number of shares, in which case it becomes a financial liability. That was the focus, chart number 2, where the mode of payment is supposed to be equity shares. Let's, I think, have a look now at the chart number 3, which is a blend of the chart 1 and the chart number 2, because I'm going to consider the mode of payment as cash and equity shares combined. So let's have a look at the chart number 3. In the meantime, let me also see if there is any questions coming further. Nothing so far, I guess, all good to go. Okay, so I guess let's take it further. So now I'm focusing in terms of the chart number 3. Now, in terms of the chart number 3, we are focusing in terms of the mode of payment is shares as well as cash. So I'm considering the mode of payment in this particular case as shares as well as the mode of payment is cash. So for convenience, let's consider the principal component is paid in shares, and let's consider the return is paid in terms of cash. So let's consider that we are going to consider the return is paid in cash, and let's consider the principal element is paid in the form of shares. So let's consider some permutation combinations. In this case, considering the principal is fixed or variable shares, and the return is mandatory or discretionary in nature, and decide upon the permutations combination. So let's create a wonderful chart out here. So I'm going to consider the permutation combination. Let's take the principal, the return, and the nature of the instrument. So let's consider the principal. Let's consider the return in the form of dividends and interest. And we can consider the nature of the instrument. Is it FL, equity, or maybe a compound financial instrument in this case? So let's consider the permutation combinations in this case. Number 1, Let's consider in terms of principle, I will give variable number of shares and the return is mandatory in nature. So the moment I say it is variable number of equity shares, it means it is FL. The moment I say it is mandatory return in nature, it again means it is FL. So both the components are financial liability, and if both the components are financial liability, overall, the instrument becomes a financial liability in nature. Let's consider the number of share is fixed, and this is again mandatory in nature. Or let's, I think, keep the combination same. Let's take it variable and discretionary. Let's consider variable as a base with mandatory and discretionary nature. So you can see variable shares with either a mandatory or a discretionary combo. Now, when I say it is variable, it is a financial liability. When I say it is discretionary, it is equity. So this is going to be FL plus equity, and this becomes a compound financial instrument. So it's very easy, when you pick up the terms and you look at the terms mandatory, discretionary, redeemable, irredeemable. So you would have noticed so far that when the focus is cash, the focus immediately comes on mandatory, discretionary, redeemable, irredeemable. When the focus is in terms of shares, your mind tells you fixed or variable. So immediately you should start thinking, when I say shares, fixed and variable on the agenda. When I say cash, mandatory, discretionary, redeemable, irredeemable on the focus points. And that's how we can apparently decide. There could be certain advanced combinations as well, but this is to begin with, the basic combinations to understand. Let's look at more combinations. So let's say this is now fixed and this is mandatory. So we can consider fixed and discretionary. Here again, you can see both the permutation combinations are working out here. So in this particular case, when I say it is fixed shares, it is equity in nature. And when I say it is mandatory, it is FL in nature. So equity plus FL, and that makes it overall compound financial instrument. And if you look at the fourth combination, it is fixed. That means it is equity, discretionary, that is again equity. So both the elements are equity. So we can say overall it becomes an equity instrument in nature. So these are the three permutation combinations based on a three-step model which I've given you. Let's, I think, quickly consolidate the learnings on this. I'm just going to make a quick recap on the agenda with you, so that we get it very clear. So this is the initial crux in terms of Ind AS 32. So let's remind you back. When you're focusing in terms of Ind AS 32, the focus is on the issuer. As an issuer, when you go to issue the instruments, you need to decide for the presentation in the balance sheet, is it supposed to be equity, own funds? Is it supposed to be liability, loan funds? Or is it a blend of equity and liability? And that's called a compound financial instrument. So Ind AS 32 becomes more pertinent from an issuer point of view, where he needs to take a call whether the instrument is to be presented as equity. Is it going to be presented as a borrowing financial liability, or is it going to be split in terms of liability as well as equity? So remember, the very first focus point is that you need to decide two components on a separate basis. Decide the principal component separately. Is it FL equity? Decide the interest and dividend return component separately. Is it supposed to be FL equity? Take a different call for the principal component and for the return component, and then take decisions. So your step number one would only focus on that the obligation is contractual in nature, not legal. Legal means by contract, by law. But when I say financial instruments, it is only contractual in nature, not by law. Income tax payable, as I said, is an obligation by law, but it's not contractual in nature. So when you say, yes, there is a contractual obligation, your focus goes to the step number two on the mode of payment. If your mode of payment can be only two things, either cash or in terms of equity shares, if your mode of payment is by way of goods and service, it cannot be a financial instrument. So like, for example, as I said, you get an advance from a customer and you're going to give him goods and services in return. It is not supposed to be a financial instrument. If your mode of payment is cash, immediately this chart should flash into your mind. You should start thinking that, okay, if I'm looking at the principal element, redeemable FL, irredeemable equity. If it is return element, mandatory FL, and discretionary is equity. So immediately when I say cash mode of payment, this chart should flash at the back of your mind. Similarly, if it is equity shares, this chart should flash into the back of the mind that is it going to be predetermined fixed shares equity, and if it is shares to be decided later, variable in nature, then it is financial liability. So the moment I say cash, the word should flash. The moment I say equity shares, fixed and variable becomes the key focus. And based on that, I give you three combinations. If you're going to consider cash as the mode of payment, you're looking at mandatory, discretionary, redeemable, irredeemable. When your focus is equity shares, you're looking at fixed or variable in nature. And the chart number 3, where the focus is in terms of both the components, you're accordingly looking at variable or fixed, mandatory, discretionary, and deciding the nature of the instrument. I hope this makes the position clear that in which cases it is equity, which cases it is liability, and which cases it is supposed to be CFI. But before we take it further, I guess let's get the balance sheet presentation very clear. Since the focus in terms of Index 32 is on the presentation in the balance sheet of the issuer, let's get it very focused, very clear that if the instrument is equity, FL or CFI, how are you going to present it in the balance sheet? So let's get this very clear. If I focus in terms of the liability side of the balance sheet, let's say this is the liability side of the balance sheet. So we are focusing in terms of equity and liability. So you've got equity to begin with. This is the extract of the balance sheet, not the asset side, just the equity and liability side. So you've got equity, there is equity share capital, and there is other equity. I'm putting it as OE, that's called other equity. And you know that this other equity is nothing, but it is elaborated with a document called Statement of Changes in Equity. This other equity which appears in the balance sheet is elaborated with the help of a document which is called SOCI, Statement of Changes in Equity. And in this particular case, you know that this SOCI is divided in terms of 3 tabs. The SOCI is divided in terms of 3 tabs, that is tab 1, 2, and 3. Your tab number 1 is supposed to be equity component of CFI. The tab number 1 is equity component of compound financial instruments. Your tab number 2 is the reserve and surplus, including the retained earnings. And the tab number 3 is what enters in the other comprehensive income. So let's put it again. So when you look at the other equity in the balance sheet, the other equity is elaborated with a document called SOCI, that is part B of SOCI. Because part A of SOCI elaborates the equity share capital. So when you look at the other equity in the balance sheet of any company, you need to look at the details. The details are available in part number B, SOCI, and the SOCI is got 3 tabs. The tab number 1 is equity component of CFI. The tab number 2 is supposed to be reserve and surplus, and the tab number 3 is whatever enters in the other comprehensive income of the company. And then after this, you represent the liabilities. And in the liabilities, we are considering borrowings. And in this borrowings, we've got what we call financial liabilities. So this is financial liability borrowings. Now let's have a little key focus on how do you present the instrument. If a company is issued a pure equity instrument, then you would present it as equity share capital. If a company is issued a pure financial liability, you're going to present it as a borrowings in the balance sheet. But if you say that the instrument is supposed to be CFI, then the financial liability element will be a part of the borrowings, but the equity component is going to be a part of the other equity in the balance sheet. Let's get this very clear. If it is a pure equity instrument, you're going to present it as equity share capital in the balance sheet. A company issues non-puttable equity shares. It's an equity instrument. So when a company would issue non-puttable ordinary shares, it's an equity instrument. So you're going to present it as equity share capital. If you say that it is a pure financial liability, you're going to present that pure financial liability as a borrowings in the liability side, non-current liabilities in the balance sheet. But if you say it is a compound financial instruments, you will split. If it is a compound financial instruments, you will split the proceeds between the financial liabilities and the equity component of the instrument. The equity component is a part of the other equity which settles in the tab number 1 of SOKI. And the debt component is a part of the financial liability. So our next focus is also how do you do this split accounting? How do you split the proceeds of a compound financial instruments in terms of the debt that is FL and in terms of equity? I think that was important to show you the balance sheet presentations of 3 kind of instruments. If it is a pure equity 1, if it is a pure FL2, and if it is a case of a compound financial instruments, how does the split accounting get presented in the balance sheet? So far, so good. So this is one aspect of our discussions in terms of Ind AS 32. Now we are going to take the journey forward. And I am now going to give you inputs on a compound financial instruments in this particular case. So we're going to see how the split accounting is done. For that, I'm going to take a small little question as well, just to keep you, reminded on how the accounting for a CFI takes place. So let's go further. The next stage of discussion. So my next area of discussion is the split accounting. We've seen the presentation aspect. Now, the next area of discussion is we're looking at the compound financial instruments. How do you decide the split accounting? What is the technique of doing a split accounting between the two? How does the subsequent accounting also takes place? So let's first of all understand one thing. I'm not saying always, please mind the words carefully. I'm saying generally. Generally what happens when as an issuer, you give the holder an option to convert instruments into ordinary shares at a future date. As an issuer, I'm giving an option to the holder that, okay, you are getting an option to convert into ordinary shares in the future. I would generally land up giving him interest lesser as compared to a non-convertible instrument. So let's say to a non-convertible instrument, I am paying a 9% interest rate. To an optionally convertible instrument, I will never pay 9%. I'll generally pay below 9%. The reason is that the holder is getting an option to either consider cash, he gets a cash, or he gets, the option to take equity shares in the company. He cannot get his bread buttered on both the sides and eat it too. So invariably, you will see that if there are optionally convertible instruments, you will notice the interest rate, the coupon rate on non-convertible instruments is greater, and the interest or the coupon rate on convertible instruments is going to be slightly less. Generally, of course, less. So let's consider when you're looking at compound financial instruments, what do we need to do? You need to take the proceeds as a base. So whatever total money is being raised at time 0, you're going to consider that as a base, and this proceeds will be split between 2 elements. This proceeds will be split between 2 elements. What we'll do, we'll calculate the financial liability and we will calculate the equity as a balancing figure. So we're going to consider the proceeds as a base, and we will calculate the financial liability component, and the equity will be a balancing figure. Now, what we're going to do in terms of FM, we will take the present value of future cash outflows. We will consider the present value of future cash outflow. This is in terms of principal as well as in terms of interest or dividend. So I will say, okay, what are the unavoidable obligations? Mind the words, what is the unavoidable obligations in terms of interest and dividends to be paid and the principal money to be paid? And we will take the present value of all the future cash outflow. When you consider the present value, in this case, we will consider a discount rate. And that discount rate is, you can say the coupon rate. You can say it is the coupon rate on non-convertible instrument, on non-convertible financial instrument. So we will put across a question to ourselves. We will say, okay, let's evaluate that if this instrument would have been a non-convertible instrument, what is the coupon rate we would have paid? So we will take the present value based on a coupon rate on a non-convertible instrument and take the present value of future outflows. We get the financial liability. And then whatever is a balancing figure, so let's say the proceed is 10 lakh, let's say the financial liability is 9 lakh, you're going to consider a balancing figure equity. So the entry which is done at the inception looks something like this. The bank is getting a debit with the proceeds. The financial liability is going to get a credit with whatever you have computed. And the equity element gets a credit, and that is the balancing figure in this entry. So this is the journal entry which we are going to pass at the very inception. So when a company is going to issue a compound financial instruments, once you've zeroed down that yes, it is a compound financial instruments, then in this particular case, the bank gets a debit with the total proceeds raised at time zero. The financial liability will be a computed value based on the present value of future cash outflows. And whatever is a balancing figure, that is the equity component which goes in SOKI, that is in tab number 1, other equity in the balance sheet of the company. So I think let's take an example to get this a little more clear. So let's take a very basic example from the study material, on the basis of which I will tell you how the split accounting is done, then how does the subsequent accounting of this FL, and how does the subsequent treatment of this equity component takes care. So I'm just going to take some facts, a small little question. I'll just share that facts quickly to you. So let's take an example to illustrate the accounting of a CFI. So let's take an example on a compound financial instrument. So I'll just give you some quick facts. I'm considering, let's say the proceeds is to the extent of 10 lakhs. Let's say the proceeds is to the extent of 10 lakh. The instrument is got, let's say, a total tenure of 3 years. And let's consider it's an optionally convertible instrument. So in this particular case, let's say the coupon rate, which we are paying is at the rate of 6% per annum. I'm also given the status that there is a coupon rate without conversion. There is a coupon rate without conversion option. So there is a coupon rate which is without conversion option. That's, let's say, 9% per annum. So the company in this case is giving a 6% coupon, but had the instrument been issued without a conversion option, we would have given a 9% interest in this particular case. Okay, so let's consider the simple facts itself to do this. So this is the proceeds for an instrument which has got a 3 years life. So in this particular case, I would be able to easily conclude that it is a compound financial instrument because in this particular case, the coupon rate is much lesser as with an option to convert. So this is definitely a CFI. Now let's see, how do we do the split accounting? So in order to do the split accounting, In order to do the split accounting, what we'll do, we'll consider the proceeds as a base. The total proceeds is 10 lakhs, and we need to split this between FL as well as the equity component. So we want to split this between the FL and the equity component. So what will I do? I will consider the present value of all the future cash outflow. So what is the future cash outflow? You're going to pay a 6% coupon rate on 10 lakh. So on 10 lakh, if I pay a 6% coupon, that works out at 60,000. So we are going to pay an interest of 60,000 for the next 3 years. So my cash outflow is 6% coupon rate for the next 3 years, but this will be discounted at a 9% coupon rate. So we consider at 9% PVIFA. So I need a PVIFA at the rate of 9% for a period of 3 years. So let's calculate 1 divided by 1.09. Again, 1.09. 3 times, get a GT, that's 2.531. So we have taken the payment of interest for the next 3 years, which is 6% discounted at a non-convertible instrument. So PVIFA 9% 3 years. And then you're also going to pay the principal money back. 10 lakh will be paid at the end of 3rd year. So we need a PVIF at the rate of 9%. That's 3rd year end. So you're going to pay the interest for the next 3 years and you're going to pay the principal at the end of the 3rd year. So let's take at 9%. 1, 2, 3. That's 0.772. And on this basis, we can get the financial liability element. So very simple. What we are practically doing in terms of financial liability, we are considering the present value of all the future cash outflow. But remember, discounting is to be done at a coupon rate, which is without conversion. So you will say, okay, what are the future streams of cash flows? What is my obligations in terms of the 3 years and discount it at 9%? It gives me a financial liability. So this is going to be 60,000 into 2.531 plus another 7,72,000. This is, I think, coming to 923,860. So you can take equity as a balancing figure out of the proceeds of 10 lakh rupee, reduce the financial liability. So this comes to 76,140. That is the balancing figure, which is equity component of the instrument. Now, I would also like to give you the treatment for the next 3 years. How would my accounting in terms of FL look like for the next 3 years? What is going to be the status of this equity component at the end of 3 years? So first, let's look at the FL. Then we're going to look at the equity components as well. So let's take the picture further. So let's do one thing. Let's make a ledger account in this particular case. So I'm creating a ledger account. Instead of putting entries, I am conveniently considering a ledger account. It's a little easier to look at the movements in terms of ledger accounts. We are able to correlate the data fast. So I generally advise, and I generally, do that as well on my own. I always prefer to make a ledger account in terms of liability. So the first entry you're going to put, that is bank. So what is the journal entry we're going to put? In this case, bank gets a debit of 10 lakh and the financial liability gets a credit 923,860. So we're going to put the financial liability 923,860. And let me just remind you something which you have learned throughout Indian accounting standards. And trust me, this is true for any Ind AS you might pick up. This is conceptually what I'm telling you is true in all cases. Remember, in terms of Ind AS, whenever you consider a present value of future outflow, it'll lead to unwinding of discount of finance charge in the future. And remember, whenever you go to consider a present value of future inflow, Whenever you're going to consider a present value of future inflow, it'll again lead to unwinding of discount and result in a finance income. You heard me correct? Let's put it again. In Indian accounting standard, be it any standard, if you consider the present value of outflows, you'll have unwinding finance charge. If you're going to consider the present value of inflows, you'll have unwinding finance income. The present value of cash outflows will result in unwinding of discount of finance charge. The present value of inflows will result in, you can say, unwinding of discount, that is a finance income. So every stage you are considering a present value of outflow, get ready for finance charge. You're considering present value of inflows, get ready for finance income. So what is this? This is the present value of all the future payments. So we unwind this and we consider a finance charge, which is going to be taken at the rate of 9%. The discounting of this was done at 9%. So you're going to do the compounding of this also at 9% itself. The rate at which the discounting was done, the same rate at which the compounding is going to be done as well. So let's take 9%. So 923,860 into 9%, that's 83,147. The coupon rate which we are paying is not the outflow. The coupon rate which we're paying is not the interest to be debited to P&L. The interest to be debited to the P&L is this figure. The element of interest which will enter in the profit and loss account is not that 6%, but that is 9% which is accrued. Now, at the end of the year, you paid a coupon rate, which is on the face value of 10 lakh. You paid a 6% coupon rate. So we paid 60,000. 60,000 is not in the P&L. 60,000 is not going to go to the P&L. 60,000 is the repayment schedule. You told the person, you give me 10 lakhs today, I give you 60,000 at the end of first year, second year, third year, then I pay you 10 lakhs at the end of third year. But the interest to be recorded in the books of accounts is the interest at which discounting is being done. So let's consider the balance CD as a balancing figure. So we're going to consider this as a balancing figure, and this will become the opening balance next year. So this is 923,860 plus 83,147 minus 60. That comes to 947,007. So this is 947,007. Again, do the unwinding at the rate of 9% on this. So we take a finance charge at the rate of 9% on this again. And if I take a 9% interest on this, it is 85,231. 85,231 approximately. Then again, we made a payment at the end of the second year, which is the coupon rate of interest, 6%. We get a balance CD as a balancing figure, and that becomes the opening balance next year as well. We're going to see the position till the end of third year. So 947,007, 85,231 minus 60, this is 972238. This is 972238. Again, we consider a finance charge at the rate of 9%. Well, I would say in the last year, let's not calculate the interest. We'll rather take it as a balancing figure to match things up. So we're not going to consider any interest at this stage. Let's leave it out here. Now let's consider you made a payment. Now, there are two interesting things which will come up at the end of the third year. Since it is an optionally convertible instrument, the holder gets a choice. He would either say, I want cash, or he would say, I want equity shares. So let's consider both the cases. If he says, I want cash, what is the status of accounting? If he says, give me shares, then what is the status of accounting? So let's look at both the permutations and combinations and have a look in terms of how would the accounting look different. So let's consider two cases. Let's consider two alternative cases. One is the holder says, I want cash. The second option is he says, I want equity shares. So he may exercise one of the two alternatives in this case. So either he says, I want shares, or he says, I want cash. If he says, I want cash, I'll give him 60,000 interest and the principal money, both in terms of cash. Because we owe the obligation in terms of interest and the principal. So if he says, I want cash, I'll give him the interest and the principal both in cash. If he says, I want equity shares, that interest will be given in cash. Rest 10 lakhs will be given in the form of equity shares, which might be at a premium as well. So I'm not giving you the status or number of shares. So we can say the equity share capital plus the premium put together is the 10 lakh. So either the entry is bank, the full amount of 10 lakh 60, or it is 60,000 in cash and 10 lakh in the form of shares and the premium. So let's do one thing. Let's take this as a balancing figure just for convenience. Though it should approximately come to 9%. So 10 lakh 60 minus 972238. This is coming to 87762. Let's also cross verify that whether this figure is almost 9% of the opening balance. So let's divide this by 972238. And if you divide this, it is approximately coming to 9% itself. That means the calculations are absolutely correct in nature. So this is how the accounting of the financial liability component is done. Mind the words, this is how the accounting for the financial liability element of the instrument is done. But there is an equity element also which is there. And let's have a look at what happens to that equity element. So let me just take you to SOKI. So let's consider for the equity component, let's consider SOKI. So we've got a tab number 1, we've got a tab number 2, and we've got a tab number 3. So let's say this is my tab number 1, this is my tab number 2, and this is my tab number 3. So this is the SOKI extract which we are creating. This is the extract of SOKI which we're creating. So in the same example which I started off, when we did the split accounting, we got the equity component as well. 76,140 is the equity component. So this equity component would have been taken in tab number 1 of statement of changes in equity. So 76,140. So the 76,140 is what is lying out here. This is the equity component of CFI. This is a reserve and surplus, and this is the other comprehensive income. Now, please hear me carefully. Let's, I think, give you the inputs at this stage. Now, what happens to this equity component of CFI at the end of the third year would all depend upon whether the holder opted for shares or whether he opted for cash. Because the holder has got an option to either he wants shares or he wants cash. Now, what do you need to do in this particular case? If the holder says that I want cash, if the holder says I want cash, I am going to transfer this money to the retained earnings at this stage. This is what I'm going to do at the end of the third year. So if he says that I want cash, then this money is become free. It will be shifted from one component of equity to another component of equity, and that is it's going to be transferred to the retained earnings. But if the holder says, I want, in this particular case, shares, if he says, I want shares, I will again shift this money to the tab number 2, but this time it will be capital reserve at the end of third year. This time it will be transferred to the capital reserve. So in any case, it will be shifted from tab number 1 to tab number 2, but whether it will go to the retained earnings or whether it will enter the capital reserve all depends upon the conversion is in cash or shares. If the holder says, I want cash, I'll put this money in the retained earnings in tab number 2. If he says, I want shares, I'll put this money in the capital reserve. So this is how the equity component would be treated at the end of the third year. The financial liability ledger is being prepared, and this ledger is what we technically say it is prepared at amortized cost accounting. The financial liability component or the compound financial instrument is accounted under EC, that is amortized cost accounting, where the unwinding of the finance charge is taking place at the end of each year, and you're making a coupon payments, agreed coupon payments, contractually agreed coupon payments. So your accounting of financial liability takes care of, you can say, accounting at EC, amortized cost accounting, and the equity component remains intact for 3 years. It remains intact for 3 years in the tab number 1, but it shifts to the tab number 2 only at the end of the 3rd year, depending upon whether the option is to exercise shares, it becomes security premium. Sorry, I said retained earnings. Sorry, my mistake, not capital reserve. If we say shares, it's going to be security premium. Some people also say it will be capital reserve instead of retained earnings. So I think that's not very clearly given in the standard. So if we say shares, I'll put it to security premium. And if it says cash, it is capital reserve. Some people have an opinion capital reserve, though if you look at the standard, it says it is transferred from one component of SOKI to another component of SOKI. So one component of SOKI means tab 1 to tab 2, but what heading within the tab is something which is not clearly written in the standard. But I guess if you ask me technically, capital reserve is more preferable. Here it is security premium for sure. So the moment he says, I want shares, the excess money which he paid is indirectly a share premium. And the moment he says cash, it becomes a capital gain for me, and I would put that money in a capital reserve. That is how the tab 1 money shifts into the tab 2 at the end when the option becomes exercisable in nature. Now, there is one special issue which I think we need to discuss. I may not do a practical illustration on that, but I think I need to give you some insight, because even in the study material relating to this compound financial instruments, there is one special issue as well. So let's do one thing. Let's, I think, quickly give you insights on the special issue. So the main focus in terms of Index 32 is been, two areas. One is deciding the instrument is equity, FL or CFI, on the basis of which I give you a 3-step model and I give you a total of 3 charts to decide the fate. The second key focus point is in terms of compound financial instruments, where I give you the feel of a split accounting. How does the ledger of an FL and how does the equity component, is accounted in case of CFI. Now, there is a small little special issue relating to CFI, which I think I want to make a run through, at least, theoretically with you. The special issue is relating to TC in case of CFI. Yes, you heard me correct. TC, that is called a transaction cost. So that is called TC, that is called a transaction cost, because when you issue the instrument, there could be certain transaction cost which is incurred at the time of issue. So what happens to that transaction cost is what we need to understand. Now, what's the steps very carefully in this case? Now, when you are given a TC in case of a compound financial instrument, I would say the focus point is like this. Step number 1, you are going to do the split of the proceeds. You're going to split the proceeds. So you're going to split the proceeds between FL as well as equity. And while doing so, you are completely ignoring TC. Your step number 1 remains exactly the same. You do the split of the proceeds between FL equity and you're not concerned with the TC at all. Just keep that TC at the background. Step 1. Then you go to the step number 2. Now, in terms of the step number 2, what do you need to do? You need to split this TC as well. Whatever transaction cost is being paid, you are going to divide this TC in this ratio. So this TC will be split between FL and equity in the ratio of figures in step 1. In the ratio of figures which are given in step number 1. So that's what we need to keep in mind. So in this particular case, what you're going to do, I will consider the TC and I'll split the TC in this ratio. So whatever is this figures, we're going to split the TC in this particular ratio. So you will be able to identify that out of this TC, this relates to FL, and out of this TC, this relates to the equity component. Now, what do you need to do further? In step number 3, what you're going to do, we've got FL and we've got equity. So you've got FL and equity. Now, the TC related to FL, the TC which relates to FL is going to be reduced from the figure out here. So let's say this is A. And let's say the figure which you got here is B. I'm considering an FL. So the figure which you got here is A and the TC component is B. So what I'll do, I'll consider A minus B. I'll consider A minus B. As far as the TC related to equity is concerned, this will be charged to other equity directly. This will be charged to other equity directly. You can expense it off against retained earnings. So this can be charged to other equity directly. This can be adjusted against the retained earnings itself. So let's get the position once again very clear. If a company issues a compound financial instrument and you notice that there is any kind of transaction cost which is attached, if you see that there is a TC which is attached to the CFI, do one thing. First, do the split accounting. Divide the proceeds between FL equity the usual way which we saw in the previous question, ignoring any TC. Then in step number 2, what you need to do, the TC is to be divided between FL equity in this ratio itself. Whatever is this ratio, you need to divide the TC in this given ratio itself. Whatever is the TC relating to equity will be directly charged to the retained earnings other equity. But as far as the TC relating to FL is concerned, you are going to net it off A minus B and you're going to net it off. Now, one most important inputs, what do you need to keep in mind? The moment you have done the netting of the TC from this particular figure, remember there is something which will trigger now. And what will trigger? You cannot use the discount rate which was used for split accounting. You need to recompute the discount rate. Because in the step number 1, you ignored the TC. So whatever discount rate was taken in step 1, you cannot use that. You need to consider a recomputed discount rate. So in this particular case, you'll have to recompute. You'll have to recompute the new, you can say, interest rate. And you cannot take the interest rate which you have taken in terms of step number 1. This is the crucial point. You cannot consider the discount rate which you've taken in step number 1. You'll have to recompute this rate. So would this new rate be given to the question? 99% maybe. And if not given, you'll have to basically calculate what we call effective rate. This new rate is nothing, but it is called an effective interest rate. I think let's give you a very basic flavor, just with some figures, just to give you an insight in terms of things. So let's take a very simple example without getting into complications, a very simple example. So let's take a simple example to run through these 3 steps. I'm just taking arbitrary figures and I'm just going to take some arbitrary figures. I'm not going to technically compute anything, just to give you a basic idea. So let's say the proceeds is to the extent of 10 lakh. Let's take the same example which we did earlier. You calculated the FL and the equity component. Let's take it from the previous example. I think let's take the same figures. So let's say this is 923,860. This is 923,860 and this is 76,140. So I've taken the same example which I took previously. So this is the proceeds split between the two, and this is like my step number 1. Now let's consider that you've got TC. So let's take the TC. So let's say the TC is to the extent of 20,000. So let's do one thing, split this between FL as well as equity in the above ratio. So let's split this up. So we can divide this 20,000 into 923,860 divided by 10 lakh. This is 18,477. And related to equity is 1523. So simple, what I've done, I've taken a TC for the extent of 20,000 and this 20,000 is divided in this ratio. So divide it in this ratio, that becomes my step 2. Then let's go to the step number 3. Now, in terms of the step number 3, what do you do? As far as financial liability is concerned, you take this 923,860. You need to reduce the TC, that is 18,477 from this. You need to consider a net proceeds. So 923,860 minus 18,477, that works out at 905,383. And as far as the TC related to equity is concerned, that is 1523. This can be charged to I. This can be directly charged to retained earnings directly itself. Now, everything is fine, but what do you need to do in this particular case further? Because everything else is perfectly fine. So what do you need to do now further in this particular case? You're going to consider this particular figure and you need to make your financial liability ledger, because now you need to do unwinding as well. Now, the question is, when you took this financial liability, you took a 9% coupon rate to discount. Your financial liability in step number 1 was based on 9% coupon rate. Now, in this particular case, when you consider the EIR, it cannot be 9%. It cannot be 9%. You need to relocate the new figure. How would you relocate the new figure? I'll tell you. If it is not given in the question, how do you locate that? See, you will consider a cash outflow to the extent of 905,383. And you're going to consider the cash inflows, which is for a period of 3 years, 60,000. And at the end of 3rd year, another 10 lakhs. Initially, when you calculated the step number 1, you took the present value of all this at 9% and you got this figure. Now you need to see what is the discount rate at which the present value of all this, what is the discount rate at which the present value of all this is equal to 905. And you will definitely get it more than 9% for sure. Because your outflows have gone down. Earlier, you would have taken the outflow at 923. Now you're going to consider the outflow as 905. So if you need to recompute the effective rate of interest, what do you need to do? Organize the data. Take this net figure as a cash outflow. You're getting 60,000 coupon rates each year and you're getting 10 lakh. You will definitely get the answer 9% plus for sure. Calculate the internal rate of return. That internal rate of return would represent the new effective interest rate. So once you get the new effective interest rate, you will be able to make the ledger account for the financial liability. So the moral of the story, that if there is any TC which is given in relation to a compound financial instrument, what do you need to do in this particular case? You do your split accounting in the usual manner. That's one. Then you need to split the TC in this given ratio. Whatever is the TC related to FL, that is to be netted off in terms of financial liability, and equity will be directly taken to retain earnings. And whatever is the net figure which you get, now it's time to locate that new effective interest rate. You need to basically get a new EIR. So sometimes the examiner might be kind enough to give you that effective interest rate. And if not, you need to organize this by considering the outflows and the inflow. Take the net figure as an outflow and the coupon rates and the principal as inflow. Get the new internal rate of return, which is the effective interest rate. And then the ledger accounts will be made accordingly. So this was as far as accounting of compound financial instruments are concerned. So are we done our inputs in terms of Ind AS 32? Yes. That was a quick inputs given to you on Ind AS 32. So there are two major aspects we've understood on 32. One is the aspect of identifying the instrument FL, EI, CFI. And the second is in terms of identifying the compound financial instruments and doing a split accounting with and without TC. I think now it's time to give you a little break as well. I'm sure you'll need one. Before we start off a journey in terms of Ind AS 109, for which I need to give you a lot of things because we are going to spend some time today and, of course, in the next session as well. 109 has got a lot of things to cover, and we've got limited time in which we've got a lot of things to cover. So I think as of now, let's, I think, first give you a break and then we'll start a journey. Let me see if any questions coming in so far. I think so far, so good. Okay, so I think let's give you a break, friends, for around 10, 12 minutes. And I see you back after the break. Enjoy your break. Topic indeed. But we, I think, covered the aspects of Index 32, that is presentation of financial instruments. Now we're going to go to the next phase of discussion, and that is we're going to discuss Index 109. But I think before I start my discussions on Index 109, I think it is necessary to first get a little grip in terms of what are the various issues, what is the flow of the standard, so that accordingly, as we go forward, we are able to get a good grip on the standard. So let's, I think, first of all, create a small little mind map. This will give us an idea of how the standard stands organized and what is the flow in which you need to really understand this particular standard. Well, as we can already see that financial instruments has got two parties. One is issuer and one is a holder. And our focus so far has been only on the issuer perspective. So I think let's put the chain like this. So I would say, let's broadly classify this from two parties' point of view. So we can look at an instrument from the point of view, number one, of an issuer. And number two, we could focus in terms of the holder. Now, it is with reference to Index 32 that you are able to decide whether it's a financial liability, whether it is an equity instrument, or whether it is a compound financial instrument. And for this particular purpose, I give you a three-step approach. My discussion so far in the morning has been on the aspect of deciding when the instrument is FL, equity, or CFI from the issuer point of view, and we're applying a simple three-step model. And we've also seen the accounting for CFI as well. We've not seen the accounting of FL per se, but yes, we've seen the accounting of FL component of a CFI. Now, coming to the next focus point. The moment you say that it is a financial liability or equity instrument or a CFI, we need to consider Index 109 from the holder's point of view. And in all these cases, I would say in all these cases, he would say it is a financial asset. But we're also now going to cover a three-step model here as well. This is what my next thought or process is. I've covered this three-step model telling you how to identify from the issuer point of view. Now we're going to cover another three-step model deciding that what is a FL for the issuer is what for the holder, what is equity instrument for the issuer is what for the holder, what is a CFI for the issuer is what for the holder. So we need to understand, first of all, the classification of this financial asset. So we can say we need to understand the classification. How would you classify these financial assets? And this is one focus point of discussion. So that is one thing. Second, as we move forward, once we've understood this particular phase, the next area of discussion is we need to understand the accounting of financial liability, which we're going to cover in terms of Index 109. As far as accounting for compound financial instrument is concerned, we've already covered this in terms of Index 32. That is, we've covered the concept of split accounting. So in terms of accounting, as far as accounting for equity is concerned, there is nothing to be learned. Because as far as equity is concerned, it doesn't change. You put the entry bank account debit, equity share capital credit, and it remains intact throughout the life. So our focus is not in terms of accounting for equity. The focus is accounting for FL, which we learn. And the focus is in terms of accounting for CFI, which we've already learned. Similarly, we will also learn the art of accounting for financial assets, which can be at amortized cost, can be at FPTPL, or it can be at FPTOCI, which has got variations of R as well as NR. So we need to understand the accounting of financial assets in the books of the holder. So once we're able to get a grip in terms of classification of financial assets from the holder's point of view, then we come to the accounting of financial liabilities, financial assets in detail. This is the core part of the standard where you get questions in the exam. So this is where we're going to spend some more time in terms of things. Next, the journey doesn't end out here, but the journey goes forward and we are confronted with some more special issues of discussion. And these issues are more from the point of view of the holder rather than from the point of view of the issuer. But there are certain things which are common. Like, for example, we need to consider the concept of derecognition of financial liabilities. We need to consider the concept of derecognition of financial assets. Derecognition means the removal of asset, the removal of liability in the books of accounts. So when you remove that financial liability out of the balance sheet, when you remove the financial assets out of the books, so there are certain principles which are based out here. So in this particular case, just to remind you, the derecognition could lead to two kinds of accounting. One is called a modification accounting and one is called an extinguishment accounting. So there is a 10% test which, decides all these things. I'm just trying to give you a chain of thought. So there is a 10% test which, decides the fate of derecognition accounting. Are we going to apply the concept of modification accounting? Are we going to apply the concept of extinguishment accounting? So the 10% test decides the fate of these things. Now, as far as the derecognition of a financial asset is concerned, here again, I'm going to give you a three-step model wherein we are going to learn the aspects in terms of what we call the risk and reward test, the control test, the cash flow test. So this is the basis, the basis is a cash flow test, a risk and reward test, and a control test, which decides whether removal of the financial asset can take place from the books of accounts or not. Then I would say comes the further journey. And I would say then there are certain special issues which governs the accounting typically of financial assets, like for example, impairment of financial assets, ECL. So there is a special agenda. What we need to learn is the ECL concept. That is, we need to consider how do you consider the impairment of financial assets. Well, there is no concept of impairment of financial liabilities. Liabilities do not get impaired. It is only that, the impairment of financial assets would take place, and that is using the ECL concept. Then there are certain more special issues which are discussed in the standard. And if we look at the special issues which are given in the standard, we can say there are two special issues in the standard. One is regarding the concept of ED, not Enforcement Directorate. It is called the concept of embedded derivatives. So we need to understand the accounting for derivatives. This standard gives you how the accounting for derivatives is done using an FPTPL, what we call a mark-to-market margin approach. And how does the concept of embedded derivative takes place? And then there is another special accounting which is called hedge accounting. So I would say in a nutshell, these are the special agendas which are there. If you connect in terms of the various issues, you can say we've got these plethora of issues which are there. So as of now, we have just covered, if you ask me what we have covered so far, we've just covered this particular part of the standard. That's it. And you can see Index 109 covers so many issues indeed. So our first focus point of discussion for the day is going to be looking at the classification of financial assets. Then we'll focus on accounting of financial assets and liabilities. Then there is a derecognition concept. Then there is impairment testing. There is embedded derivatives and hedge accounting. I don't know how much we'll be able to cover up in the next session because we've spent 15 lectures, I've already said, in detail, covering up all these aspects in detail. So my focus point is going to be, these areas to begin with. Whatever time we get, we'll give you a little briefing in terms of other areas because we need to do it fast. We've got limited time on that. So let's begin the journey. This was a mind map which I've intentionally given you. And this is all given in terms of Index 109. This is the mind map in terms of movement. So let's begin our journey in terms of 109 classification. So let's go on. So my focus now is coming on financial assets. My focus now is completely on financial assets. I've covered these steps in detail in the detailed lectures, but I think now I'm just going to quickly take a run through in terms of the various inputs, what we've already discussed in detail. So I'll just take a quick run through on these things. Well, we're going to make a run through of a three-step model where we're going to look at what is the classification of financial assets. But at this stage, let's clarify one thing very clear. All financial assets are initially measured at a fair value with certain exceptions. So when we're looking at the classification of financial assets, it is not for the purpose of initial recognition, but it is for the purpose of subsequent accounting. So when we're looking at the classification of financial asset, it is for the purpose of subsequent accounting, not for the purpose of initial recognition. So let's get this one thing very clear, that if you're looking at initial measurement, if you're looking at initial measurement of financial assets, I would say initial measurement of financial assets is always at a fair value. So initial measurement of all the financial assets is always at a fair value. We do not classify the financial assets for the purpose of initial measurement. All the financial assets are taken at a fair value, but there are certain exceptions, and there are basically two exceptions. When it is not taken at a fair value, the exception number one is there is a loan which is recoverable on demand. There is a loan which is recoverable on demand. I gave a loan to someone and that amount of loan is recoverable on demand. We are going to record the loan at a transaction value and not at a fair value. What is the transaction value? If you give a loan of 10 lakhs to someone, that is a transaction value. The loan is going to be recorded at 10 lakh itself. And the second is the case of a trade receivable. So under these exceptions, we will record at transaction value. We will record at a transaction value itself. So this is one basic thing what we need to keep in mind when we're looking in terms of accounting, that this is always at a fair value initially, with the two exceptions we're going to record things at a transaction value. So the classification what we're looking at, the three-step model what we're looking at is meant for subsequent accounting. So when I'm looking in terms of financial assets, the classification, this is for subsequent measurement. This is meant for subsequent measurement. So initial measurement, we've already made it very clear, is always at a fair value. It is only for subsequent measurement we need to classify the financial assets into various categories. And just to remind you, the various categories of financial assets are either it is taken at AC, or it is taken at FPTPL, or it is taken at FPTOCI, or it is taken at FPTOCI. So one is FPTOCIR and one is FPTOCI, that is no recycling. So I think let's put it once again, let's consolidate the picture before we give you a three-step model. So if somebody were to tell me that when you're looking at accounting for financial assets, what is the focus point? I would say the focus point is that you need to measure all the financial assets at a fair value. All the financial assets will initially be always taken at fair value, with the two exceptions, debtors and loan recoverable on demand. Number two, it is only for the purpose of subsequent accounting that all financial assets can be into four broader categories: AC, FPT, OPL, OCIR, as well as NR. So for this particular purpose, what I've done in the detailed lectures, I had given you a three-step model which will help us clarify how do we decide the given category for financial assets. So let's go on to the three-step model now. And we'll see the logics and all I've already given. Why we do use an AC approach, why do we use an FPTPL or OCA approach, all those detailed logics I've already given in those detailed sessions. So today I'm not going to give you logics on that. I'm just going to remind you the chain of thought in terms of which combinations, which measurement principles would apply. So let's begin the journey. So we're going to draw a three-step model. So let's have a look at a three-step model and remind you the chain of thought. Step one, step two, and step three, and finally the remarks. So we're looking at the financial assets accounting, that is subsequent accounting. So I'm looking in terms of step number 1, then I'm looking in terms of step number 2, then we're looking in terms of step number 3, and then we're looking at what is the measurement principle which will apply based on the 3-step model. Now, your first focus, your step number 1 is always, as an issuer, you need to step into the shoes of as a holder, you need to step into the shoes of the issuer. The standard requires that a holder is supposed to step into the shoes of the issuer and put across a question, what would he call the instrument as an issuer? So the step number 1, the focus is always that you step into the shoes. You step into the shoes of issuer. You step into the shoes of the issuer. That is your first focus point. If I invest in a particular instrument, let me put a question to myself. If I was the issuer of the instrument, will I call it as FL? Will I call it as equity instrument? Or will I call it as a CFI? So let's go to the permutation combination. So we decided in this particular case, if from the issuer point of view, he says it is equity instrument, then we can say from the holder's point of view, we can say it is a financial asset equity investments. So the moment he says that it is supposed to be an equity instrument, we would be able to immediately say that it is a financial asset that is equity investment for the holder. The moment it says it's a financial liability, it is a financial assets that is debt investments. So it is a financial asset, but we call it as a debt investment. And you say it is a compound financial instrument, it again becomes a debt investment in this case. So the first focus point is you step into the shoes of the issuer. You don't need to give a phone call to the issuer, but you need to step into the shoes of the issuer. You need to see that if I was an issuer of the instrument, his FL, my debt investment, his CFI, my debt investment, his equity instrument, my equity investment. So that's what is you need to decide in terms of step number 1. Next. In step number 2, you need to basically do a risk assessment. In step number 2, you need to basically do a risk assessment. And the focus points which you need to remember out here, when you're looking at a risk assessment, you are deciding that is the risk there or not. You're just deciding is the risk there or not. So in this case, you're deciding the risk is there or the risk is not there. We're just deciding one simple thing. We're just deciding that there is a risk or is there not a risk. And for this particular, we have got a common test, and that is called CCFC, comprising SPPI test. It's a common test whether it is for equity or whether it is for debt investments. There is a common test which decides the fate whether the risk is there or not, and it is called a contractual cash flow characteristic comprising solely payment of principal and interest. So whether it's a debt investment, whether it's an equity investment, it's a common kind of a test which is applicable to both equity as well as applicable to debt investments as well. And then comes the third step. And in terms of the third step, again, we need to do a risk assessment again. In terms of the third step, again, we need to do a risk assessment again. This time, we need to look at a reconfirmation, risk is not there. Or we need to see that, yes, if the risk is there, what is the intensity of the risk? Is the risk high or is the risk low in nature? So at this particular stage, you need to basically do a risk assessment. You need to reconfirm that there is no risk. And if there is a risk, you need to decide the intensity. Is the risk high or is the risk low? The focus in terms of step number 2 is to see the presence or absence of the risk. The step number 2 focuses the risk is there, the risk is not there, but doesn't focus on the intensity. But in this particular case, you are looking at the intensity of the risk in step number 3. You're reconfirming that risk is not there. And if the risk is there, you're deciding the intensity of high and low risk as well. And in this particular case, there are two different tests available. So if you're looking in terms of a debt investment, there is a different test involved. And if you're looking at an equity investment, there is a different test which is involved. Unlike the step number two, where the risk is the same, the test is the same. But in terms of step number three, if it is a debt investment, we use what we call a business model test. And if you look at an equity investment, we use a test which is called held for trading test. And accordingly, after applying these three tests, you are able to reach a conclusion. Are you going to measure it at AC? Are you going to measure it at FPTPL? Are you going to measure at FPTOCI? And I think just to remind you, before we make a comprehensive movements of permutation combinations, let me just remind you, we decided that in this particular case, AC will be taken when you reach a conclusion that there is no risk. So when based on the three-step, you reach a conclusion that there is no risk, we're going to use AC. And FPTPL is when we're going to say that the risk is very high. And FPTOCI, when we say the risk is not that high. It is high, but the risk is not that high in nature. So based on the second and the third steps, you are able to zero down the risk is not there. If there is no risk AC, if it is high, it is FPDPL. If it is not high, it's moderate, it is OCI. And we also said that in terms of debt, it is always recycling. In terms of equity, it is always no recycling. So I think let's take a quick recap in terms of this three-step model. Then we go to the detailed permutation combinations. I'm going to create a total of three charts with you. Chart number one, where we're going to consider equity investments. Chart number two, when we go to consider a debt investments arising out of FL. And chart number three, if it is a debt investments arising out of CFI. So we're going to make three charts. The way we made three charts in the morning for Index 32, issuer perspective, we're going to make three charts from the holder's perspective. And let's also look into the default categories in terms of different measurement base as well. Let's consolidate the picture. So the three-step model in terms of financial asset is focus one. You need to step into the shoes of the issuer. His FL, my debt investment. His CFI, my debt investment. His equity instrument, my equity investment. So you decide what is the nature of the investment. Is it equity or is it debt investment? Looking at the issuer perspective. Your step number two is on a risk assessment, looking at the risk is there or not, whether it's a debt or equity investments. It's a common test called CCFC comprising SPPI test. And similarly, in terms of step number three, reconfirming there is no risk, or if there is a risk, looking at the intensity, high or low. And for debt, there is a different test business model. And for equity, there is a different test, which is called held for trading test. And depending upon the level of risk, if it confirms that there is no risk, it is AC. There is a high risk FPTPL. There is a mid risk FPTOCI. And for debt, it is always recycling. And for equity, it is always no recycling in nature. I guess so far so good. Let's take the journey forward. Okay, I think Viraj and Abrakesh have joined. I think you've got a couple of doubts coming in. We'll surely give you a chance in another 10-15 minutes. We'll come back to your doubts. I'm sure financial instruments will have a lot of doubts indeed. So we'll give you an opportunity very shortly on that. So let me, I think, first go ahead and create my three-step model chart based on this. So let's make three charts to you. Based on a general inputs on this, let's make three charts. I'm looking at step number one. I'm looking at step number two. I'm looking at step number three, and we'll decide a measurement base. So this is my chart number one. We're going to make three charts on this. So let's consider the chart number one to begin with. So I'm looking at step number one. Then step number two is risk assessment. Step number 3 is again a risk assessment. And then finally, we decide a measurement based on the risk assessment. What kind of measurement base would we choose? Now, let's concentrate on combination 1. I looked at from the issuer point of view. And he classified the instrument as equity instrument. So from the holder's point of view, we can say it is supposed to be financial asset equity investments. So when you look at things from the issuer point of view, we say it is equity instrument, and then we say that from a holder's point of view, it is equity investments in nature. Now we go to step 2. In step 2, we look at CCFC comprising SPPI test. If you invest in equity instruments of another company, will you get a contractual right to receive cash in terms of principal as well as in terms of interest? The obvious answer is no. Because if you invest in the equity instruments of another company, they've got no obligations to pay interest and principal, and therefore you get no rights to receive principal and interest. So this test will 100% fail in this case. And if 100% fails, it means the risk is there. Undoubtedly, the risk is there. So we can undoubtedly say that if you're looking at equity investments, we can be 100% say that step number 2 will fail. So practically, is there a need to apply a step number 2? I would say no. In terms of the step number 2, we are outrightly saying that this test will definitely fail. This indicates the risk is definitely there. Then we go on to the third step and we look at held for trading test. We apply the held for trading test, wherein we need to basically see that is this investment held for trading or not? Is it short-term or is it long-term in nature? And let me remind you, when you're looking at investments, for example, investment in related parties is not covered under the purview of this particular standard. Ind AS 109 is covering investments, but it is covering only those investments which are unrelated party investments. So in this particular case, if you've got equity investments, I would say yes, they are held for trading, or I would say no, they are not held for trading. If you say yes, they are held for trading, it means that there is a high risk. And if you say no, they are not held for trading, well, the instrument is risky, of course, but if you're not trading, then the risk reduces. So I would say it's not that high. I would say it is not that high in nature. The failure of the step number 2 definitely indicates the presence of the risk. We're just looking at the intensity. Is the risk high or is the risk not that high? And accordingly, when you say the risk is high in nature, this is going to be taken at FPTPL. And if the risk is not high in nature, the standard gives you a choice in this particular case. The moment you say that it is not held for trading, the standard doesn't say FPT OCI, but it gives you a choice in this particular case. It says FPTPL is the default choice, or you can consider FPT OCI. There is no recycling if you want. So the default is FPTPL unless you choose an FPT OCI. The default is FPTPL unless you choose an FPT OCI, which means that if somebody were to ask me in terms of chart number 1, that what is the default measurement, I would say equity investments is always taken at FPTPL. Equity investments will always be taken at FPTPL. Your held for trading investments, undoubtedly FPTPL. If it is not held for trading, this is something which you need to choose. If you don't choose this, by default, we consider that you are under FPTPL. It is only if the question explicitly tells you that I am choosing an FPT OCI, then it would apply. Otherwise, default is PNL. Which means, can I say that if I look at a question and as an investor, you invested in equity shares of a company, what is the measurement base? FPTPL, that's it. Unless I am clearly given that I have chosen OCINR, by default, it is FPTPL. That makes my life simple. which means even if I don't go through the process of this chart, the moment I am given the question that there is a equity investments, I would say FPTPL, unless the question tells me very clearly that I'm chosen an FPT in this case. As simple and as straight. This is chart number 1. Now let's have a look at another chart number 2 as well. So let's consider a second permutation combination. So let's go to the chart number 2. So again, let's make a walkthrough on the 3-step model in terms of another permutation combination. Step 1, step 2, step 3, and we decide on the measurement base. So step 1, then step number 2, then step number 3, and we decide the measurement base as well. Now, in terms of the 3-step model, if you look at the second combination, let's say the issuer says it's a financial liability. So let's say we look at the permutation combination. The issuer says it's a financial liability. The holder in this particular case is going to say it is a financial asset, and that is supposed to be a debt investment. So it is a financial asset, and that is supposed to be a debt investment in this particular case. So his FL is my debt investments. We go to the step number 2 and we look at CCFC comprising SPPI test. Now, since it is a case of a debt investments, the other company, the issuer, has got an obligation to pay principal as well as interest. And as a holder, we definitely get a contractual right to receive the principal and interest. And if I get a contractual right to receive principal and interest, I would say in terms of this combination, I will 100% pass this test. Because in terms of equity instruments, the other party will never have an obligation to pay. But unlike a financial liability will always have an obligation to pay. So in equity investments, I'll not get a right to receive. But in terms of debt investments, I'll definitely get a right to receive, provided it's a financial liability from the issuer point of view. So if this passes, it indicates that there is no risk. But we still need to reconfirm this in terms of step 3. Even if you have decided in terms of step number 2 that you have passed this particular test, it indicates that there is no risk, but you still need to go and reconfirm that there is no risk. So we go to the step number 3. And in this case, now we need to apply a business model test. For debt investments, there is a different test. For equity, it was held for trading, but for debt investments, it is called a business model test. So there are 3 kinds of business models which can arise. Either we decide as a holder to keep the investments till maturity, or we decide to sell off the investments, or we decide we might keep them till maturity, or we might sell. It's a blend. You might sell or you might keep it till maturity. It's a blended combination. So the moment you say that it is an investment to be held till maturity, which means what? This means that I am looking at that the other person will pay, and I'll keep the investment till he pays. I will collect every rupee of rights which I've got. This makes it investment very safe, and we would say that there is no risk. If you were to say that there is going to be a sale of the investments, you're going to trade in these investments, there is going to be a high risk in this particular case. And of course, if you come to the combination where it is a blend between these two, we can say, in this case, we can say it's not that high. The risk is there, but it is not that high in nature. And accordingly, once you make the assessment on the category of the risk, you reconfirm there is no risk, or you decide the intensity of the risk. Now we can decide what would be the measurement base. So in this case, we will use AC. In this case, it will be FPTPL. And in this case, it will be FPTOCI. And since it's a debt investments, it is recycling. And if you remember, I also gave you that in this case, And in this case, the company can choose an FPTPL, but that is something which is condition based. Even if you fall under AC, you can still use FPTPL. Even if you fall under OCI, you can still choose FPTPL, but that has to be very clearly stated in the question. So the question rises, what is the default measurement base as far as debt investments is concerned? AC. Unless there is anything given to the contrary, I would always assume that these investments are meant to be held till maturity. We are not going to sell these investments in the near future. So whether it is a case where you're going to sell the investments or it is a blended business model, this has to be very clearly stated in the question. So the question is silent. The default category is maturity and it's going to be taken in AC, which means if it is equity investments, FPTPL default. If it is supposed to be debt investments, which are FL based, it is AC by default. Life becomes simple in that case. Now let's have a look at another chart number 3. So let's go to the chart number 3. That is the last combination of chart. Then I think after this, we can start asking questions on your side. So in this particular case, when I am looking in terms of chart number 3, let's look at now the case of CFI. So step number 1, step number 2, step number 3, and the measurement. So we've got step 1, we've got step 2, and we've got step 3, and we're going to consider the measurement as well. So let's have a quick look now in terms of the permutation combinations. If I say from the issuer point of view, it is a CFI, then we can say from the holder's point of view, it is supposed to be a financial asset debt investments. It is financial assets, that is debt investments. And trust me, here again, the life is very simple, because when you're going to look at a step number 2 and you're going to look at the CCFC comprising SPPI test, in this particular case, this will 100% fail. Rather, I would not say 100%, I would say generally, it's better to go on a safe side. Unlike 100% in the previous 2 cases, I would say it'll generally fail. And why would it fail? The test says that there is a contractual cash flow which is solely, the word is solely, arising out of principal and interest. You need to get cash which is solely, you need to get solely in cash. But in terms of compound financial instruments, they are optionally convertible instruments. So you may get cash, you may get shares. So it is not necessary that you get solely in cash. You may get cash, you may get shares. So this test will generally fail. And if it fails, there is no need to go to step 3. You simply go to FPTPL. That's it. So I think the moral of the story is very clear in this case, that if you ask me what is the default measurement for these kind of categories, I would say it is FPTPL. So a very important inputs to be given. Equity investments, FPTPL. Another one which I'm adding, derivative investments, FPTPL. Debt investments in CFI, FPTPL. And debt investments in FL is AC, which means whether you look at equity investments, whether you look at derivative investments, whether you look at, you can say, debt investments in terms of CFI, these are all at FVTPL by default. You're making equity investments, derivative investments, debt investments in CFI. It is only if you've got debt investments in FL, then the default is AC. So except for a debt investments in FL, which is AC, the rest all is FPTPL. That's it. So this was a quick run through in terms of the three-step model, classifying the instruments from the point of view of the holder for subsequent accounting. Your initial measurement of all financial assets except debtors and loan recoverable on demand is at fair value. Rest it is either AC, FPTPL, FPT-OCI, or NR, depending upon the cases. But this is in short a default measurement categories for various components. I think that takes care of another phase. So I think let me just run it back. I started with a mind map, and in terms of the mind map, I've covered this aspect further. So if you ask me, we've covered this aspect further. And my focus is now going to be on this, which I will take after the queries, of course, otherwise the next class. So this part is the section is over. So I think we can perhaps now go back to the query sessions, I guess, last half an hour. So let's open the gateways to you. Yes, beta Ab Rakesh. I hope I pronounced your name correct.
Good morning, sir. Yes, it is correct.
Good morning, beta.
Oh, correctly.
Yeah.
Sir, a very basic question on the numbering of the accounting Ind AS.
Okay. How do we number them?
Ind AS 107 and 109.
Okay.
Sir, generally we disclose anything once we recognize and measured it. Now, in this case, first numbering has been given to disclosure part, Ind AS 107, and then recognition and measurement. I mean, what is the logic behind it?
I'll give you the logic. Wonderful question indeed. So I'll give you the logic also. Do you know the logic of why is it 101?
That
you
is,
want me to give a little insight on that
because
also?
of earlier accounting standard and thereafter Ind AS, based on.
I'll tell you. I'll tell you the entire little history to understand this better. I'll give the answer in two parts. I'll first give you one part, then I'll come to the specific part which you had. Number one, if you look at IFRS and if you look at Ind AS, IFRS has got a total of 4 inputs. One is IAS, one is IFRS, one is IFRIC, and one is SIC. When I use the word IFRS, it comprises of 4 documents: International Accounting Standards, International Financial Reporting Standards, then IFRIC, International Financial Reporting Interpretations Committee, and SIC, which is called Standing Interpretations Committee. Now, what we did when we created this Ind AS, we decided that we're going to call this as Ind AS. We're going to call this as Ind AS. And we're not going to call them anything as such. So we came to a bigger problem. We've got IS 1 to 41, we've got IFRS 1 to 16. Now the problem was, if IS 1 is also called Ind AS 1, it's okay. But in this particular case, I can't call IFRS 1 as Ind AS 1. So what we did smartly, we took the series 101 to 116. Just to distinguish IS series and the IFRS series, we took the series for IFRS as 101 onwards. That is one thing. Now, as far as this IFRIC and SIC is concerned, they were inserted in the appendix to relevant Ind AS. They were inserted to the appendix to the relevant Ind AS. So when you open up any Ind AS for that matter, you'll see Appendix A, generally is on definitions. Appendix B is generally on AG, application guidance. Then there is Appendix C and D. Appendix C is giving you some kind of an interpretations. So you will notice that all those IFRICs and SIC have been presented in Appendix C, Appendix D of the relevant Ind AS. That is how we organize the Indian accounting standards. Now coming to your question in this particular case. In terms of financial instruments, there were basically 3 standards in IFRS. One is IS 32. One is IS 39. And the other one is IFRS 7. So there were 3 standards: IS 32, IS 39, as well as IFRS 9. Now, originally, if I were to place them under Ind AS, this is of course called Ind AS 32. And this is what I would have called Index 39. And this is what I call it as Index 107. So now question is getting answered. You're saying that why 107 came before that? No, it did not. Then later what happened that in terms of IFRS, they revised the standard and deleted the standard and created IFRS 9. That was after IFRS 7. IFRS 7 was already made. And then IFRS 9 came after IS 39. So what we had to do, we had to change the name to IFRS to Index 109. So we made this as Index 109. And therefore, when you look at Index 109, it seems that it is coming after 7. Because 107 had already born before 109 came.
Okay, got it. Thank you.
Answer?
Sir, another question. In case of finance instrument for equity, it's only equity shares or preferred shares also included?
Well, it depends upon the parameters. Like, we saw in the charts in the morning, and I very clearly said that the name of the instrument is not relevant. So you can't say that preference share is always a financial liability, but looking at the Indian scenario, most of the time, because preference shares will be redeemable in nature, they will turn out to be financial liability. But I don't, preclude the possibility of preference shares becoming equity instruments.
So basically, we should, in case in exam question it has been given, what should be, our treatment?
Okay, let's consider a combination that you've got irredeemable preference share. I know you will tell me that as per company law, you cannot issue irredeemable preference share. Let's not get into that contradiction.
Yes, I agree.
But let's say there is an irredeemable preference share on which there is a discretionary dividends. So how would you classify that instrument?
It's a discretionary, so it's equity.
Correct. So it's a preference share, but you rightly said it becomes equity in nature. So we cannot preclude the possibility of preference shares getting classified as equity instrument depending upon the terms and conditions attached to the instrument.
Okay. Thank you.
You're welcome. Okay, I think Viraj is also there. Yes, Viraj. You got any questions, Viraj?
No, sir.
Okay. Okay. Any further questions, Abhirakesh, you've got? Otherwise, I'll take my inputs further. Any further questions coming to your mind?
Sir, it's reference to the calculation of when there is a transaction cost. We have to
In terms of
the transaction cost for accounting entry for the liability.
Okay. Today, in fact, I discussed the aspect of TC on a compound financial instruments.
Yes.
I'll just quickly run through that. Then I'll tell you about financial liabilities through that only.
No, sir. My question is towards, recalculating the discount rate. When it was in the given example, you have, given the example, it was 6% is for convertible, 9% is for non-convertible.
Right.
So there is a transaction cost. It needs to be revised. So there it has been revised for 9,05,000, some last three figures.
Yes.
And
Yes.
10,60,000 is our actually inflow earlier. Actually.
Right.
Now, my question is when, transaction cost has nothing to do with interest cost.
Okay. Okay.
So why we should revise with respect to interest cost also? Why not only to 10 lakhs?
Okay. I got your point. Now, let me, I think, ask a few questions to you before I explain that in detail. If you look at the treatment in terms of IGAP, I'm talking of accounting standards. The position was very clear that if there is a TC, it used to be immediately expensed off. It used to be immediately expensed off. Do you agree with this treatment?
Yes.
Are you convinced with the logic of this treatment, or do you think it was not logically correct?
No, it's logically, logically correct.
Okay. So let me, I think, criticize that treatment now. My question is that you're raising, let's say, 10 lakh rupee, and to raise this money, you incurred 20,000 rupee. Is this 20,000 a cost incurred for the next 5 years or just for time zero? This money which you have raised is for the next 5 years. So is this 20,000 going to be a
Zero.
cost incurred for the next 5 years or at time
No,
zero?
it's for time zero.
Okay. You incurred it at time zero, I agree. But you see, at the end of the day, are you not getting the benefit of this financing for the next 5 years? Am I right?
Financing, yes.
Correct. So there is one viewpoint, which Indians took. You're incurring a cost at time zero. Agreed. But the question is, you always expense and cost on the basis of benefit derived. Like, for example, if you purchase an asset, you don't treat it as a revenue expenditure on day one. You start taking a depreciation over a period of time because you know that you're getting advantage for the next 5 years. So even this 20,000 TC which you're incurring will give you a benefit for the next 5 years itself.
You mean
So,
amortization?
Sorry?
Amortization of TC.
Yes. So indirectly, when we came to Indies, now let me say a slightly technical thing. If it clicks, I think it clicks in a second. Can I say what we decided was that you are going to net off this 20,000. So what will happen? You're going to say that I got 9.8 lakhs. And you're going to calculate your new internal rate of return. Do you think this IRR will go up or go down?
IRR goes down.
No. You see, in terms of liability, you were keeping cash outflow 10 lakhs on one hand, and you were keeping the cash inflows on the other hand. Now, if you reduce the cash outflow with the same inflows, can I say IRR will go up?
Yes.
Right? So if the IRR increases, will it increase the finance charge as well?
Yes.
Correct. So can I now make a statement that indirectly the TC is getting entered in the P&L in the form of increased finance cost?
Yes.
So are we indirectly doing a deferment unlike immediate expensing in terms of IGAP, considering that this money spent is for the benefit of the next 5 years? So let's apportion it in the ratio of interest cost indirectly over a period of 5 years. I guess I'm making sense.
But sir, interest cost is for every year. I mean, it's
correct.
For example, 60,000 is for particular year out of the 3 years.
Right.
So why we should consider that benefit also going to the next remaining 2 years, because there is another 60,000, another 60,000.
Okay, so let me now say another technical input. Just vouch this carefully because it will be difficult to prove it without figures, but I'm just going to make a statement. Can I say if I take the finance charge without reducing this TC and you get a finance charge after reducing TC, do you think the difference in this finance charge will be equal to TC?
Yes.
So indirectly, by reducing the TC from the financial liability amount, what you're doing, you're enhancing the finance charge, wherein you're indirectly amortizing, deferring the TC in the ratio of finance cost, which can I say will periodically keep coming down? Because you'll keep enjoying the benefit of loan. First year you enjoyed the benefit of 10 lakh. Yes. And then you keep making a payment, so the benefit enjoyed is going down. So would the interest cost also go down? So they thought the best way to defer the interest cost is, because most of the people would have said, let me amortize it straight line 5 years. But would amortization 5 years straight line make more sense, or amortizing in the ratio of benefits make more sense, which means amortizing it in the ratio of the interest cost itself? So they decided to inbuild the impact of TC into the EIR rate itself, which will take care of the deferment in a very scientific manner.
Okay.
I hope you got the answer clear.
Yes. Thank you, sir. No question.
Okay. Any further questions? Because I think Viraj has got no questions. Any further questions?
No, I don't have. I don't have.
Okay. That's wonderful indeed. Okay. Then I think for a little short while, I think I have some time. So let me just quickly do some more exercise for the next 5-10 minutes. Because we have got more extensive inputs. So I'm just going to take you back on the mind map which I created. So this is my chain of thought. So I'm going to take it a little further now. Now, Because next class, what I'm going to do, I'm going to do a little practical illustrations, because I think especially the TC, is a very killing experience. So what happens to the TC under various situations, what happens to the processing fees and other parameters is what we'll discuss in detail. So coming back to the picture now, we are very clear with one thing. In terms of Index 32, we decided that financial instruments can be broadly classified into three aspects. As an issuer, it's either a financial liability, then it gets presented as a borrowing in my balance sheet, liability. If it is an equity instrument, pure equity instrument, it gets presented under equity section, that is equity share capital. And if it is a compound financial instruments, you got to make a division and you got to divide the proceeds in terms of FL as well as equity. The equity portion enters the other equity and it is a part of, you can say, the tab number 1, which you've already seen ultimately with either enter into tab 2 in the form of security premium or in the form of capital reserve, as the case might be. Then we saw in terms of the holder's perspective that his initial recognition is always at a fair value. But in this particular cases, his subsequent measurement all depends upon the criteria, and that is, whether it is AC, whether it is FPTPL, OCI, etc. Now, I want to quickly make a chart where I just want to present different aspects of FA accounting, which we can use in the next session. So let's make a quick chart on the financial assets. So this is a quick accounting chart, very important chart from the financial assets point of view. I would say there are broadly 4 categories of FA. One is AC, OCI, RNR, as well as FPTPL. So we're going to make a quick summary chart in terms of financial assets. The basic focus is on initial subsequent measurement. I just want to capture at least the theoretical aspects. We can keep doing the practicals later on that. So let's consider a column for particulars. Then we're looking at AC, FPT, OCIR, FPT, OCINR, and let's consider FPTPL. So these are the 4 broad categories under which any of the financial assets would fall. So let's do some quick charting on this. Number 1. Which category is applicable to debt investments and which category is applicable to equity investments? So let's have a look at which categories would apply to debt and equity. So AC applicable to debt, OCI are applicable to debt, but NR not applicable to debt. FPTPL can also apply to debt. Equity investments, AC not, OCI are not, but it can be OCI NR or it can be FPTPL. So equity investments could be either of the two. Debt investments could be AC, OCI, PNL, anything. But remember that R is supposed to be for debt. As we said earlier, NR is supposed to be for equity. Now let's look at some more inputs in this particular case. So we're looking at initial measurement. So when I'm looking in terms of initial measurement, let me make it very clear. This is always at a fair value. All the categories of financial assets will always be at a fair value. But I think we need to keep into mind the concept of TC. So what do we do? Unlike FL, we're going to add TC. In this case, add TC. In this case, add TC. But in this case, you're not going to add TC. TC in this case is immediately expensed. It is going to be immediately expensed. So all the cases TC is added except the case of a PNL where the TC is simply expensed in the PNL. Next. We're looking at the subsequent measurement where I'm considering, do we consider fair value changes or not? Now, initial measurement is at a fair value whether it is taken at AC subsequently, but whether the fair value changes will be taken on a subsequent basis. For AC, no. In this case, it is yes. In this case, it is yes. In this case, it is yes. And we very clearly know that in this particular case, the fair value changes enters in the OCI. Here also it enters the OCI, and here the fair value changes, increase, decrease, whatever. Any change in fair value, whether it's an increase or decrease, is all captured either in the OCI or it is captured in the P&L. Now, the most important and the crucial point, the concept of effective interest rate. I think this is something, which people generally tend to falter. That when does the concept of EIR apply? So let me keep one thing very clear in mind. Remember one thing, that the concept of equity never considers EIR. The concept of EIR, which is effective interest rate, only applies to debt, and it applies to debt irrespective it is AC or it is OCI. So the concept of EIR is going to apply in terms of AC, yes. Is going to apply in OCI-R, yes. But in terms of OCI-NR, equity, no. FPTPL, no. So when it is FPTPL, the concept is not applicable. When it is supposed to be OCI-R, it is applicable, but NR is not applicable, because NR applies to equity. And remember, EIR is a concept relating to debt investments, never to equity investments. But even if you're using FPTPL, which is applicable to debt equity, EIR would not apply. And also to remind you, when does the concept of EIR trigger, which, I will give you a stress next time as well, that the concept of EIR triggers on account of 3 factors. I'm going to use this input next time as well to explain a little more inputs. EIR concept will trigger if there is any discount on issue, if there is any premium on redemption, if there is any kind of transaction cost given. Trust me, these are the 3 areas jahan aapki ghanti dimag mein baj jayegi. I read the question, I see there is a discount on issue. I read the question, I see there is a premium on redemption. I read the question, there is a TC. If any of these 3 things are present in the question, that will definitely trigger the concept of calculating an effective interest rate in the question for sure. And I think another point which I like to make at this stage is the concept of impairment. Because these are small little issues which sometimes bother us, and we need to be very clear on which concept triggers at which stage. So when we're looking in terms of the impairment aspect, we need to be clear which one will be covered in impairment. If it is AC, yes. If it is OCI-R, yes. If it is OCI-NR, no. And if it is FPTPL, again, no. So impairment concepts would trigger only in terms of debt investments, not in terms of equity investments. It is only if it is a debt investments which is AC or OCI-R, then it'll trigger. So in terms of debt investments, when you're taking the fair value changes in OCI, now that's important. When you're taking the fair value changes in OCI, you need to see if there is any impairment aspect. That impairment aspect will be entered in the P&L, and the remaining fair value changes will enter the OCI. So when it comes to FPT, OCI, NR, entire fair value change goes in OCI. When it comes to FPTPL, entire fair value change goes in P&L. But when it comes to FPT, OCI, R, you need to split the fair value change between what is impairment that goes to the P&L and what is other than impairment enters the OCI. And in terms of AC, no fair value changes are captured. Another important aspect is regarding the profit or loss on sale of the investments. Here it will enter the P&L. Here it will enter the P&L. Here it will enter the OCI. Mind you, it is OCI. This is another area which needs to be very cautious on, that in terms of equity investments, even if you sell these investments, the profit or loss on sale of these investments will enter the other comprehensive income and not in the P&L. So there are 2 important focus points on equity investments. The impairment is not conducted, the fair value changes are in the OCI, and even the profit or loss on sale of the investment again enters in the OCI itself. Right, so far so good. I think that was a quick recap in terms of financial assets. Now what I need to do, a little focus, is what I'm going to do in the next session with you. If I just come back to the mind map. So as I created this particular mind map with you, so my next focus of area is going to be giving you a little more accounting in this part. So coming Tuesday, we've got another session on financial instruments. So we'll try to make the best out of that in terms of things. I know condensing 15 hours, 15 classes in 2 sessions is a big deal. But I think what I've done so far is also I've condensed quite a lot of lectures which we covered. And I think almost around 50% lectures in one day today. And we'll try to condense the other part also in the next session as well. Okay, back to you for any questions. Yes, Abhirakesh.
Sir, what is recycling? I mean, in case of FET, OCI, for debt it is a recycle, and for equity it is NR, non-recycle. Now, what is that recycle mean?
Recycle is that when you sell the investments, the full amount in OCI will enter the P&L in the year of sale. That's recycling. And when there is no recycling, you transfer the entire amount in tab number 3 directly to tab 2.
Okay.
I'll give you a little example because I want to give that in detail. So next class, I'll be spending time on accounting, where I'll give you complete inputs regarding what is recycling, the treatment on the sale, what is no recycling, the treatment on sale. I'll give you the extracts of SOKIs, everything. You'll get a very good clarity on OCI, SOKI movements, etc. So wait for that.
Okay, thank you.
You're welcome. Okay, so I think that seems to be good for the day. Then I think that's all what we have time for. So see you in the next class on Tuesday. In that case, thank you. Bye-bye. Take care. Haji. Thank you, Ji.